Hi guys, it's me, Alexander Jarvis. But you probably know that since you're on my site, right? Well, I'm going to be taking you through the e-commerce financial model now. Normally, I have my gorgeous face on screen, but to be honest, setting up the green screen and all the video editing and the file size stuff is just a bunch of work. And it's frankly why I've kind of put off making more videos. Life's a little bit too short in some ways. So I'm just going to ship you some content really quickly. I haven't spent a bunch of time preparing this, but I know you'd love to actually really dig into this model and see what's going on. So I'm just going to do that for you now. So what I'm going to do firstly is run you through all the sheets in the model. And then I'll go back and give some high-level overviews about what's happening in it. Okay, does that sound cool? Whether it does or doesn't matter, because we're going to do that now anyway. So each of the models has basically a review of a guide, some things about how to not mess up the model, what sheets are in the model and sort of what they do, and some little guides about how sort of formatting works. And I apply investment banking type formatting for all this. Okay, that's kind of boring, so let's skip on. Now, the first sheet you're going to have to be filling in is the formatting sheet. There's only a couple of things you need to put in there. It's, the point at which your actuals start, when the model starts, which is the forecast date, your fiscal year end, which is related to when you pay out staff bonuses or tax. The currency stuff doesn't matter that much. And of course, you're going to pay tax, right? So you just put in that number, whatever it is, normally something like 20%, and that's it. Now, we've got three sheets here: your P&L actual, your forecast, and your combined. So your P&L actuals is, let's say you started your company in January and you've been operating for 3 months. Now, your forecast is, of course, going to be wanting to be starting in April. So you can input these dates here, and then your forecast will pick it up. So you see January, February, March, and it starts here in April. Now, then we have the combined sheet, which pulls in all of it together, and you see January, February, March, April, May. So this will pull in from your actuals, this will pull in for forecasts, and if you want to have that, you can see one nice, lovely continuation of your actuals plus your forecasted numbers. Now, we have a little summary here, which you can use for your deck. It's grouped up, which is quite often this model. So you can add line items as you want. These are some ones which I can kind of recommend since they're the most important or relevant ones, but you can add in whatever you want. And then you just, copy and paste this with a screenshot into your pitch deck if you want to. And there you go. You can chuck in your actuals. I don't really recommend doing that. At least the first meeting. You can do that in future meetings. And you can also just send them the model. Now, so those are the culmination of all the assumptions and stuff that you put into this model. So they're sort of the outputs, although there are assumptions in there. Now, the next one we have is the source and use sheet, which is something I invented. And here, this stuff here is going to help you figure out your runway and how much money you need to raise. So you just chuck in very few assumptions and it'll chuck out what you should really be doing based on your assumptions in the model, which is pretty handy, okay? And then we've got some really cool little charts like this Marimekko, which I'm trying to encourage people to start using in their pitch decks. Pie charts, this one I'm sure you've seen. Some summaries about, how your spend is going to be spent over time on a dollar basis or a percentage basis. So you can see your G&A is really high at the start and starts coming down. And then your buying cost becomes bigger and bigger over time, right? And then all this here, you don't really need to deal with. Now, next, we've got a beautiful little KPI sheet, which is a bunch of calculations to tell you, do your numbers make sense? And then we have charts, which are just pulled from each page. And there's, something like 23 here. Sorry, Mac is really slow. I hate using it, but my video editing software is on my Mac computer. So we've got a bunch of charts. You can see what's going on, traffic, and yay, it's all brilliant and fun. Now, let's start getting into expenses. So staff are, of course, going to be, probably something like 30%-ish plus of your total costs. So you want to do it properly. So this sheet does that all. So here we've got G&A, R&D, S&M, buying, production, customer care, your fulfillment. And then we have your expenses. Now, I treat this really simply as opposed to how many pencils are we going to buy, and basically making your G&A type expenses just really simple to do. Sorry. So that's your staff and your general office running kind of costs. Now, for running an e-commerce business, of course, you're going to have a bunch of other things. So you're going to be having warehousing, you're going to be shipping with delivery costs, you're going to be having return costs, customer care, you're going to have payments, and you may have different types. You'll have your server costs and email, you'll be doing photography, and maybe even using models. And then, at the bottom of each sheet, you've got some pretty graphs to help you tell you about that. Now, yay, so much fun. We've got depreciation and amortization and tax calculations. So these have been set up in a way where you basically don't need to do anything if you don't want to. But if you really want to get your nerd on, we've got this book and tax depreciation type stuff, right? But let's not get into it now. Now, we've got some of the real core horsework calculations that get done. And so you can set up your core assumptions for how you're going to make money, such as like the items per order that will happen, how how users will start becoming customers over time, the repurchase rate, which of course is really important, and how churn will happen. And then there's like a ton of calculations here. But again, let's not get into that now. Then, as an e-commerce company, you have SKUs, stock keeping units. So you'll start with some, you'll add some, and you'll remove some. And depending on how many you have, will impact on your costs, mainly for things like photography. So in terms of figuring out how your revenue are, you can set out your sales mix in terms of 3 main blocks. So shoes, apparel, and accessories, but you can change those names if you want. I purposefully didn't set this out on like a 3,000 SKU line basis because that's just way too much. So what you want to do are create aggregate assumptions, which makes sense. And I've created 3 blocks, which is more than enough for everyone for that purposes. So you can say we'll have 30% shoes, 50% apparel, 20% accessories. Our sales price will be on average how much? Our repeat rates will, because of course repeat is important, what kind of category will they buy, what the sales price would be, and then we'll have the cost base of that to help you figure out what your margins are. So you can see on average we're doing 62% margin. And for repeat purchases, we'll be at 64% margin under these made up assumptions. It's split out by outright purchase and consignment. If you're in e-commerce, I hope you understand the difference, but I've split it out in those 2 categories so you've got a higher level of granularity to play with. If you don't do things in consignment, doesn't matter, get rid of them, set them as 0, but that flexibility is built into this model. Now, the last segment that we have are marketing. So of course, you need to get customers from somewhere. So how are you going to get them? How much are they going to cost you? So I'll just skip over. Blogging, social, this may or may not be important to you. So we'll say we'll get featured in whatever blogs. This will lead to X amount of traffic. And this will, add into our social media, our presences. And effectively, it's just decreasing your paid cost, right? So we're just sort of assuming that it's free. And the same thing will apply for your emails. So there's a bunch of like crazy assumptions you can put in there. I've put in sort of research-based baselines. If you don't really know, you can just use my numbers. But if you have the detail, you can get into that. So this will forecast users that'll come out of email. Now, of course, more than likely, or the less likely these days, you're going to have to spend money to make money. So SEM, display, Facebook, affiliates, or whatever else you want to put in, how much you're going to spend, how much your CPC is going to be, and that'll drive traffic. Now, all those sheets that we just talked about will then feed into the marketing sheet, where simply put, you can decide what your conversion rates are going to be. To make it a little bit more complicated, you can sort of decide on how your funnel is going to work. The way this works is you drive traffic from blogs and social, email, paid, and just organic direct, as the way Google Analytics would put it, to your site. And then people will become registered on your site. Maybe you get their email, right? And then in your cohort build, you then decide that those registered users will then become customers over time. And you can decide the schedule here of how that happens. Okay. So that's your marketing sheet. So there we go. That is the very quick overview of the model. If this doesn't make any sense to you, feel free to run off. If this does look kind of interesting, cool, stick with me. I'm going to go into a little bit more detail on each of these sheets. Okay. So I explained about this actual forecast thing. So to set your actuals for the model to January, you would set it January. If you want to change it, you just type in March or something, right? March 2017. Yay. Well, we're in 2018 now, huh? All right. And the model would dynamically change for that. Of course, the forecast has to be after the actuals. Now, your year end of 12 basically just means December, right? But let's say you might have a March year end. You could set that as 3. The currency part just changes the headers. I have written a macro which can change this for other currencies. I just haven't shared it yet. Your tax, you just type it in and it just feeds through the model. It's very, very simple. If you don't pay tax, lucky you, but normal people do. So let's look into the actual sheet. Now, every sheet has a guide at the top explaining what the hell you have to fill in, but we'll skip that. So we can sorry, let me step back. So the way I've structured the P&L is a model that we use at high growth companies, mainly like Rocket Internet, which is built, multiple of billion-dollar companies. And it follows a very logical flow, which progressively takes you down from your PC1 to 3, all the way down to your EBITDA net income. Okay. And so you make deductions out of this over time because, for example, marketing under your PC2 can flex up and down on your profitability. So if you want also in your growth, so if you want to grow faster, your net income, if you ever get positive, is going to be less because you're growing faster. So you can understand your PC2 margins or even your PC3 margins or what the impact is going to be on that. So you'll start in by adding your gross orders, your cancel orders, understanding your net orders, your revenues, your net revenues after discounts and vouchers, cancellations, your returns, the COGS you're going to have on there, which then takes you to what we call your PC1 or your profit contribution 1. If you are, in certain countries, you have import costs, you can put that as a set of percentage of that. You then make a deduction for your COGS, which are like your warehousing, your packaging, your logistics, make deductions for your customer care. Maybe at the start you don't have any payment costs, which will sum up to your fulfillment to get you to PC2, deduct for your marketing, which is mainly paid, and then whatever branding type offline marketing to your PC3. Then you have bad debts and credit card fraud, allowance for bad debts, to get to your total profit contribution. Then here you have your general running the company across your R&D, your G&A, your S&M, your buying, blah, 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 all fundamentally your OPEX. Deducting for those gets you your EBITDA, then your net income. Okay, now in this model, I don't have your traditional, bankery, P&L, balance sheet, profit and loss integrated type thing. Why? Because it's basically not valuable at all. No one cares. Okay. What I have done, however, is made calculations to figure out your operating cash flow. So that's actually how much cash you're going to have. Okay. And this makes a series of deductions to figure that out for you. And then at the bottom, we have some key metrics to help that flow through the model. One thing to bear in mind is if you have customers already, you want to add that in. And so then in the forecast sheets, these will be added in here so that your actual customers, if you want to get repeat, will be fed through. Okay, so your forecasts combined are structured exactly the same and they're all on the same line items. So don't add in stuff randomly and forget to change the 2 other sheets because the model won't work. Okay, now your forecast looks like this, exactly the same, basically, as your actual sheet, although less assumptions. Why? Because they're being fed in through the model. Thank God. The only things you need to change are your discounts and vouchers, your cancellations, your returns, import costs, if you have them or not, just set 0 if you're not, and your fundraising. And then everything else is basically calculated for you. Okay, simples. Now, your P&L combined And by the way, this took me a really long time to figure out. It may seem sort of obvious now or not, but this was really hard for me to figure out. Like, it literally took me days. Anyway, so your P&L combined, no assumptions. It just pulls in your actual, your forecast, boom. January to whatever, 36 months, all filled in. Same thing, your P&L, you can add in your own items if you want. It just pulls it out of your combined sheet. Again, you see January, and then we have annual summaries at the end. Now, your sources and uses, as I mentioned before, will help you figure out what your runway should be and how much you should be raising. So if you say you're going to close, 6 months into your fundraising round, so that'll be June 2017. Yeah, I did this model like a year ago, okay? You say you want to raise for 18 months, so the model will figure out that your last month of runway is November 2018. So it knows you need 7.2 million by adding everything up, basically. And rounding up, you probably should raise about 8 million. Deducting for revenue, you actually should be only raising 3, but it's safer to raise on a net basis, not on the gross basis, not the net basis. But let's say you're saying, well, screw you in your model. I want to pick in how much exactly you want to raise. So I'm going to raise 3 million. Well, that'll tell you, you actually on a gross basis have got 12 months of runway. On a net basis, based on your revenue forecast, which I'm sure are really accurate, you have 20 months. Now, your Mecca will tell you that basically, you're spending quite a lot of money on buying in terms of your paid marketing, inventory, logistics, but actually for your staff category, G&A seems to be the biggest category of people. And then in terms of your staff salaries, well, G&A or R&D, you basically tech people and people running the company, right? Pie charts, spending a lot of money in marketing, general G&A, the whole buying category is quite a lot. And you're wondering, where are these numbers coming from? Well, I made these multiple line items, which just pull in from across the model, and it shows you every expense which is contributing to these and where they're coming from and how they've been input. If you don't like them, you can change them. But you can see how every single line item are contributing to helping you figure out your runway, how much you should be raising, and making those glorious graphs. And again, this took me a long time to figure out for you. KPIs, you can sort of figure out yourself. But look, I have the financial ones. You can see your margins, how your cost structure is set up, your CPOs and CACs, your LTVs, what your headcount's going to be. But, you can figure that yourself. Charts, again, simple. They're just pulled in from every sheet. There's a lot of charts. Anyway, now staff. Everyone needs this. It's a pain. I make it really simple. So at the top, we've got a nice summary of all your costs, how many people you're going to be having over time. Also show you when you're fundraising here, so you know when you want to start ramping up your scaling. So all you need to do is type in when are people starting, and you can see these will start changing. So if I say, actually, I'm going to hire people in the 1st of September 2017. Oh, wow. Suddenly changed, right? Cool. If you want to fire people for some reason, you can put in those numbers, that date too. You type in their salary, if they get paid a bonus. That bonus will be made on your year end, which you set out in your formatting sheet here. There. Now, you have the payroll and taxes here, so don't include those in your base salary and bonus. They get added separately, and it'll just add up on a monthly basis, all your people. Easy, right? There is an adjustment which I make here for recruiters. So you can say we're going to hire 5 people. Sorry, for a recruiter, every month, if you need to hire 5 people or more, you need to hire a recruiter. Okay, so you can see here, G&A headcount is going up from 4 to 10, which is 6 people, at which point the model automatically starts hiring recruiters for you. If you want to change that and say, well, whatever, recruiting is easy for me because I'm kind of a big deal, you can suddenly see you don't need recruiters anymore. But I've inbuilt that to automatically scale depending on how you think about scaling your business. The same thing works for your R&D, for your sales and marketing, for your buying, and for your production, except for these total time savers, which are coming out of your expense calculations sheet, okay? Which are your photographers and your assistants. So depending on the number of SKUs you have and your assumptions, you'll need to hire more or less photographers, and photographers' assistants. So all you need to do is set up what their salary is, and the model will tell you exactly how many people you need to hire depending on, your scaling requirements. So it's basically one less thing to think about when you start playing with your assumptions. I actually do exactly the same thing with customer care. So you just put in the salary. There's some assumptions about how many people the customer care can deal with and how many people you need. So you can see in, I don't know, month 8 or something, you need to have another person, not just one. The same thing also applies then with your warehouse staff, depending on the number of items you are shipping. For your expenses, all you need to do is say, well, for I don't know, office and stationery, like boring, do you really want to spend a bunch of time talking about phones and stuff? Say, well, look, our G&A guys, it's going to be $80 a month. Our nerds are going to be 80. Sales and marketing do a lot of gabby talking, so they're $100 a month, right? Simples. Now you can say, well, once we've raised a Series A or something, people start spending more cash, so we can increase that. So all you need to do is put in what the increased number per month is per person for those categories and the date of increase. And cool, you get to ramp up those costs at a particular point in time that you want. You can also set those to 0 so there is no increase in cost. That often quite happens when you realize how much you're spending and how short your runway is. So onboarding, if you're going to hire people, you say maybe G&A guys, get a phone, they get a normal computer, but the R&D guys, devs get a better computer. Do people travel? How much do they travel per month? And that's applied to them on a per person basis. You've got rent and service and entertainment per month, which is for buying people. Your G&M collateral will be on your sales, marketing people, and these are aggregated, therefore, by those departments. So you can see how costs allocated here by category. Yeah. And then there's some funky calculations which are done around how your bonuses are paid out. So you can see here, December 17, 95,000 K is paid out. And then here, 181. So that's the difference between your P&L and your operating cash flow. Now, expense calcs, yay, we're making progress. So we have link assumptions, which basically, they're all in green. So it means the model's connected to another sheet. And these drive some of your calculations. We'll hide that. We see our summary here. Your general costs, your cost per orders, your logistic costs, your warehouse, your customers, your payments, your technology, your production. Will this guy ever stop talking? Now, logistics costs. So you can have an optional other warehouse cost assumption if you want to. See, I've put notes everywhere. But warehousing. So you may have a warehouse of your own, also known as your mother's garage. So maybe you don't get a warehouse until you have 2,000 orders, and you need a bigger one every 5,000 orders. So your initial warehouse costs maybe $4,000 a month, and it gets more expensive over time. And you can see that, 59,000 in year 2 to 180,000 in year 3. But you don't really need to do that for a while because your orders are going to be too small for you to meet that threshold. See, 1992 and then 2476, which exceeds your 2,000 orders here. Handling costs. All right, so you have your minions, shipping stuff, Amazon style bitches, and how many orders can they each process? So we're saying, say, $1,500, 1,500 orders a month. Maybe some optimizations because they get better, so they can process 1,650 orders a month, which means that your cost per orders will be coming down. Now, how much is it costing you for packaging per order? Say 80 cents. Next, we have delivery costs. So do you do free shipping or not? If not, just set it at 0 and say, ha ha, everyone's paying me. Or maybe you actually do some free shipping. You can use the matrix to set up, depending on how many countries you do, the type of shipping you do, percentages and the cost to get an aggregate number, which gets applied to here to see what the actual cost per shipping is, right? The same thing effectively for your return costs. For customer care, you're figuring out how long does it take to service your customers, how many hours a day do they actually work. Maybe if they're working for the government, you could say they actually only work, 2 hours a day. Ha ha ha. Anyway, that'll applies to the number of orders, the processing to figure out how many people you need to have, which was impacting on your staff sheet, right? Remember I mentioned? So we have customer care here, right? It's linked to this sheet, as I mentioned. Payment costs, I don't know, you're doing credit card, PayPal, bank transfers, or if you're in Asia, maybe you're even doing payment on delivery. You can decide what the allocation is by types of payment type, because maybe some are more expensive or less expensive. What the associated costs are with that, and that just adds up to, your total cost. So in year 3, you're blowing like $500,000 on payment. Then we're going to have our server costs. I've made some pretty basic assumptions. If server costs are really impactful for you, you probably want to build your own logic, and then some costs around your emails. Now, photographers, I made this cool thing where you can decide, are you going to insource or are you going to outsource your photography? Okay, so you just change 1 or 2 and drop down menu, and it'll change. So you see 1, you see 2. Number 2 is a lot more complicated. Number 1 is easy. Someone just does it for you. You pay them $20 for every single SKU that they make. Alternative, you could say, well, I have photographers and I'm doing a lot more stuff, so they can do 1,000 SKU per month. They get more efficient over time. They have an assistant and they can do X number of SKU per month. Do you need to hire models? How many SKUs can they do? How much do you pay them? And then just whatever other random costs you wanted to kind of chuck in there for lots of fun, right? It'll depend on your model. There you go. You have your expenses. And I know I'm talking really fast, but I don't want to put you to sleep. Unless you're already asleep, in which case, sweet dreams. DNA and tax, do you really want to deal with it? No. Okay. Note, this is the same number as that, because I'm just assuming that in the future periods, basically your CapEx and EBITDA are going to be kind of consistent. It's an assumption, but let's not get into it. You can have differences between your book and tax depreciation. If you don't know what this stuff means, just don't touch my assumptions and leave them as they are. But if you want to get your nerd on, feel free. I built it for you. You can, again, if you know this stuff, you'll know how to use it. But again, you can put in the CapEx you're spending in here to understand depreciation. And then your depreciation schedule will just fold out through here. If you have net operating losses, NOLs, again, if you don't know what I'm talking about, just ignore it. Just no stress, no investor is really going to care. And this will just turn this all into a monthly number, which is going to feed into your P&L actual and forecast. Now, the cohort build is not many assumptions for you to do, but as to say, it was a lot of work for me to build. Now, you can see the summary at the top. All you need to fill in is what percentage of your COGS are going to be consignment. So I presume you understand the difference between consignment and outright. There are going to be impacts on your COGS depending if you are taking things in consignment or not. Now, how many items per order are there? So do someone buy a handbag, or do they buy a handbag, some jewelry, and some shoes, right? Again, you want the average blended number. So we'll say maybe 1.5 items per order for the first order, and then 1.7 on average for repeat orders. And then remember I mentioned with the marketing, it's going to filter through. You can decide on how long it takes before people who come to your site and register will actually become customers. So you can say maybe the first half are going to do that in the first month, and then you can add up a little bit more, then a little bit more, then a little bit more, and then eventually 100% of customers of the registered users will all end up actually buying stuff on your site. So it'll take you in total 9 months for all those registered users to actually spend some cash and put it in your bank account. Now, of those people who you drove the site that registered on your site, you could say that actually only 16% of them are ever going to fork out and pay you money. Okay, the implied conversion rate from traffic to paid is therefore 1.5%. If you have a simpler funnel, you can set this as 0 and change your conversion rate in the marketing to a higher number. So maybe that's the 1.5%. And so you can see here, this penetration curve will show the incremental change every month, and this will drive a lot of assumptions. So I split things up between paid and earned. Paid is basically SEM, right? You're paying marketing. But your earned is maybe coming through blogs, it's from emails and word of mouth. It's people that may have already some sort of relationship with you as opposed to Google adverts, right? And they may have a higher conversion rate than the paid people. Again, if you don't have a more complicated business, or if you don't want to tell a more complicated story, you can ignore this stuff if you want, or just set the numbers the same. But if you do want to do more fancy things, I've structured that up for you so you can do it without a crazy amount of modeling. Now, you can set up with what your repeat purchase rate is going to be and say maybe over time it gets better because, you stop sucking so much. And then your churn rates, you'll say on average, a customer will be with me for 4 years, which is a 2.1% monthly implied churn rate. If you want, you can increase your churn rates for the first initial months or years, if you want, because you're kind of going to suck a bit. But over time, you should get better, right? So your churn rate can come down. So you can make that a negative number for some reason if you're doing promotion or something. But basically, this 2.1% is your stable lifetime in years that you think you're going to hold people for. And then you don't want to know about this, but there are that many formulas, okay, to figure out all the calculations from you. And, we go to the end, you can see quite what this looks like. But yeah, it's crazy amounts of formulas. And this took me weeks of painful times to figure out. But all this stuff figures out all the calculations for you. Feel free to go through the calculations if you have the time. Now, for the SKUs, you have products. You're an e-commerce company. So all you need to do is say, well, starting out, we already have 100 SKUs. We're going to add in, 200 every single month, or maybe 300 every month. Of course, there's seasons. So every year, we're going to reduce about 100 of them, but looks like, 200 of them are still evergreen. Then you want to mix up what kind of products do you have. You've got shoes, apparel, accessories. Put in what the blended number is, how much you're selling for them. And then for the repeat, again, what is it that people are actually buying and what is the price they're buying them for? And then what is your cost basis for them for the new and the repeat basis? And then you kind of know your margins, right? And then the same thing is for consignment. And that's it. Not very many numbers, but they're quite impactful. And it also, the great thing about this model is it helps you think about things you may not have thought about before, okay? So it seems a lot of work, but it'll really help you think about your business in a lot more detail. Now, marketing, let's start with blog and social again, okay? So premium, moderate, niche. Premium could be The Times, some big journal. Moderate can be Vanity Fair or something, which is sort of big, but generalistic. And niche could be your TechCrunch, which is, not the biggest audience, but the people who read that may be, much more relevant to you. And so you can put in how many times you're going to get featured every month by these numbers. So of course, you probably want to factor in hiring some PR or content people for this in your HR schedule, because it looks like we're going to be featured a whole bunch and people will need to do that. And then what is the average amount of traffic that's going to come through? So if you get featured in this premium, The Times, some, big newspaper, you'll say 1,500 people come to our website. Or if you're in TechCrunch, 300 people come to your website. And so if you apply the traffic against the number of times you get featured, this generates traffic. And this traffic will feed into your marketing sheet, where then you'll have conversions on these. Now, so that was your blogs and promotions. Now it's social media. These are... Again, it's an argument to help you with investors to say that your acquisition costs will be smaller. So you can get really detailed here, but it's kind of BS, right? Unless you really have a social media play. So how many followers do you have? How many people are clicking on things you post? How often are you posting per month? How many people of those people who post will share those with their friends? And how many percentage of their friends will be sharing with their friends? If you spend enough time clicking through and understanding, what's going on here, it's sort of relatively basic. The numbers I have in here are kind of fine, so you don't need to really change them unless social media matters to you, or if you see that the numbers are becoming too big. But if this is important to you, just feel free. I have little notes everywhere which explains how all this kind of works. Again, it took me ages to figure this out for you, but if you really want to get nerd on with your blogging social media, off you go. Now, your email, again, it takes a couple of assumptions, but basically we're saying that, you're building a newsletter list. You're sending out campaigns per month. You're going to start segmenting them over time. So your conversion rates are going to be getting better. People will open them, they'll click through, they'll share them with their friends. From your emails, people will sign up to your social media, which will add in. And you're building a list, people will churn out or unsubscribe. And you can see this. And all this will basically end up sending traffic again to your website. Now, paid and organic is probably the one you actually want to pay attention to. So your email and blogger social. You can see how I've been a little bit flippant about it. You're going to spend money to get customers, basically, all right? Unless you've got some crazy viral strategy, in which, good luck with that one. But you can say, okay, we're going to have 1,000 people a month coming to our site because, you rank, you do SEO or whatever it is. And this is going to grow over time. So, these numbers get bigger and bigger and bigger and bigger. So, they're basically doubling in year 2 and 3. All right, so your paid bit. Right. So you're going to start blowing 10K a month on SEM. Then you're going to start doing display. And then, I don't know, at some point, you're going to start doing Facebook. Yay. So you can see how much money you're going to spend here. Yeah. So that's your total marketing budget. So you can see you're doing 200K in the first year, 900K in the second, and 1.5 in the third year. Now, your CPCs matter because you do $10,000 divided by, and that will tell you how much traffic you're going to generate. So do some keyword analysis, or if you're actually already in business, you can know this yourself and figure out what your CPCs are going to be and how they change over time. You see they're getting bigger, not smaller, because as you try and scale, you're not going to be able to be super optimal with things. So you should assume your CPC is going to increase over time, but you basically divide your marketing budget by CPC to get your traffic. Again, traffic. Your traffic all feeds into your marketing sheet here. Okay, we've got paid traffic, earned traffic, total traffic. Now, this is all grouped up. You can see that we're going to have a conversion rate from your traffic to registration. So that's like a 2-step conversion. So traffic comes, they register, they do something like they become an email, they participate in emails or something. And then at some point in time, it may not be immediately, but they're going to then start paying you money, hopefully, right? And so we said something like 16% of people that register will then become paid. So we're saying of that traffic, 9% of those people who've come from a paid channel will register, whereas 15% that come through email will also register. Okay. And then you can see number of registrations, the cumulative number of registrations, and that will feed into your cohort build, which will basically just tell you how much money you're going to make then. Okay. If you want to see, lots more detail, you hit that little 2 button and whoops, look at all this. So we have this saturation calculation, which I'm not getting into now. You can start seeing what your CAC and LTVs are looking like, your implied conversion rates. You see 16% for paid, 18% for marketing, which gives you implied conversion rates of something around 1.4, 1.5, or maybe even 3% on this point. So you can go as simple or as complicated with this as you want to. And then again, all that just feeds into your P&L forecast and it'll tell you how you're making money. If things don't make sense, you change your assumptions. Oh, these are called spark lines, by the way. They're like mini little graphs which explain to you like the curve of everything that's happening. So guys, that was a very quick overview of the e-commerce model. I hope I haven't scared the pants out of you. But the best thing to do is if you are actually building an e-commerce model, just get it and have a play. I promise you there is literally nothing like this on the internet because it took me freaking months to build this thing. And I wouldn't have done that if there was a tool or resource on the internet which was this dope for founders. And I build this stuff, to help you guys out because I can seriously tell you that the pittance that you're paying me for this model is like 30, 40 minutes of my time for consulting. Anyway, feel free to reach out if you have questions. God bless, guys. Bye.